Fast food restaurant sales slump as more people eat at home. And if you are lower or middle class, you are probably not surprised by this because fast food has essentially become wildly unaffordable for most people. And personally, I don't eat fast food anymore because I can't reasonably fit it into my budget. Now, not every single chain is failing, but as a whole, we're starting to see this downward trend, specifically with these chains. In particular, Taco Bell, typically the company's most popular chain, and the company is referring to Yum Brands, which is a conglomerate that owns like KFC, Pizza Hut, and some other restaurants as well, reported sales at restaurants open at least a year grew 3% for the quarter, a steep decline from the 11% growth it registered for the same quarter a year earlier when a revamped breakfast menu and the Mexican pizza fueled sales. Meanwhile, Pizza Hut's US sales slid 4% in the fourth quarter, and KFC sales were flat, with both brands' numbers also coming in below analysts' expectations. In total, same-store sales at all three chains plus Habit Burger rose 1% in the quarter, missing analysts' estimates of a 3.9% increase. And I think kind of everyone saw this coming. If prices keep going up, there's going to be a point at which people can no longer afford them, and they seem to be finding this point. The executives making these decisions seem to be so wildly out of touch that they thought they could continue to raise prices over and over and that profits would just go up proportionally. And more specifically, the McDonald's CEO back in October even bragged about the fact that they can raise prices as much as they want and consumers will continue to pay for it because McDonald's was just that good. But it's not just Yum Brands and the Yum Brand subsidiaries that are struggling, it's also places like McDonald's. A year ago, the licensed market business was its best performing unit with more than 16% sales growth. Overall, global sales at McDonald's locations opened at least a year grew 3.4% in the fourth quarter, less than analysts expected, as protests against the company in the Middle East took its toll. It's also dented its revenue, which rose to $6.41 billion, but also came in slightly below expectations. McDonald's stock fell slightly in pre-market trading. Now, when you see that McDonald's stock fell because it came in below expectations, you might also expect Yum Brand's stock price to fall as well because their other restaurants also came in below expectations, specifically Pizza Hut and KFC. But in reality, you can see Yum Brands over the past year or so is doing quite well. In the last year is doing quite well. In the last 5 years is doing quite well. And that's primarily because Taco Bell specifically continues to perform quite well, and its sales are still growing at a reasonable rate. And I would bet anything that's because Taco Bell remains one of the only truly affordable fast food restaurants left. And so I pulled up the menu for Taco Bell in Columbus, Ohio, and as you can see, this is actually really cheap. $1.19 cheesy roll-up, spicy soft potato taco, cheesy double stack enchiladas, 3 cheese stackers. Like, these are very affordable prices from their cravings menu. I could spend $10 at Burger King, say, and I would probably get 1 burger and fries. I don't even think I could get a drink for that price. Or I could get like 3 to 5 burritos here from the cravings menu for that same $10. So if you're price conscientious and you're just looking for some quick and easy food, it's kind of no contest. Taco Bell is an obvious choice. And as a result, it's kind of pulling all the other brands and the Yum brand overall along. And you're probably not going to be surprised to hear why this is happening. Prices are going up and they continue to go up, but wages for the past year or maybe 3 have remained relatively stagnant. So of course people are going to be able to spend less. Their wages are the same and the prices of fast food is increasing. I show this graph in most videos, but you can see that the employed full-time median usual weekly earnings for wage and salary workers over the age of 16. It went up pretty well, had a big spike in the pandemic, but in the past couple years from 2021, it's been dropping and remained flat for the past 2 or 3 years essentially. So people aren't earning more on average over the past 3 years. But if you compare that to fast food prices, you can see fast food prices have really popped off. This is tracked by Finance Buzz, who did their own research, and I'll show you the methodology in a second, but this is actual inflation between 2014 and 2024, and as you can see, actual inflation, 31%. Prices on average for the CPI have gone up 31% in the past 10 years. McDonald's has gone up 100%, Popeyes 86%, Taco Bell 81%, Chipotle 75%. And then there's a big grouping here around the 50%. Subway's gone up a little bit, and Starbucks has gone up a little bit. But basically, all of the main big fast food chains that you've heard of have increased their prices more than inflation. And that's because they have to continue to turn more and more profits. So whatever inflation is, they're now paying that much more for labor and for food. So they need to make an extra profit on top of that to keep their stock price going up. And in order to do that, they have to raise their prices by even more than inflation is on average. Now, as for the methodology, I will concede that it is a little bit biased. For example, they're choosing primarily more expensive or premium items, McDonald's, medium fries, quarter pounder with cheese, Oreo McFlurries, so on and so forth. And also the percentages, while they might be huge, $1 to $3 in 10 years is not that bad. However, when you look at it in terms of percent, it's a 200% increase. So the actual dollar amount is not that significant in a lot of these, like $16 to $30, that's actually a lot. But the popcorn shrimp from $6.20 to $12, 94%, that's a lot. But then you think $1.19 to $3.19, that's not actually that much. But it is still, as a percent, a huge amount of money in increase. But this graph right here gives you a pretty good idea of what fast food inflation looks like. And if you compare that to the general CPI, which tracks food, consumer price index for all urban customers. It's food at home, which is food you would buy and then cook in your house in the US city average. You can see it's gone up quite a bit, and it looks bad at first, but it's pretty flat recently. If we pull 2020 to 2024, basically from February 2023 to April 2024, in the last 16 months or so, it really has not gone up by that much. So when your wages are unchanged, your fast food prices are increasing, and the food cost at the store on average is decreasing, making it cheaper to eat at home, then of course you're going to buy food and cook at home more. It just makes sense because you can't reasonably afford fast food anymore. And you especially will have to cook more at home if you make under $50,000 a year, which is a large percentage of the people that go and purchase fast food. Roughly a quarter of low-income consumers, defined as those who make less than $50,000 a year, said they were eating less fast food, and about half said that they were making fewer trips to fast, casual, and full-service dining establishments, according to the polling in February by the Revenue Management Solutions, a consulting firm. And this is a big concern for these restaurants because this lower-income group makes up something like 30 to 40% of all fast food sales. So if those people decide it's unaffordable, there's 30 to 40% of your market just gone overnight. And they even admit this. McDonald's and Wendy's CEOs recently said they worry about losing business from these tightest budgets. And that's obviously definitely going to happen if wages are stagnant and prices keep going up. Now, to combat this loss in stock price and also loss in consumers, companies are doing two things to try and turn their business around. The first is that they are actually lowering prices. And the second is that they are lowering their expenses with things like AI and outsourcing the work. The first of the two is the plan to lower prices. Here are some quotes from the McDonald's CEO. Obviously, as we head into 2024, knowing inflation has come down a fair bit from its peak, I think our pricing we certainly expect will come down roughly in line with that as we work through the year. And a second quote, the battleground is certainly with that low-income consumer, which we talked about earlier. And I think you're going to see as you head into 2024 is probably more attention to what I would describe as affordability. And that is great to see, and to an extent that is the system working as intended. Prices will go up as long as people are willing to pay the higher and higher prices. So if you see McDonald's continuing to increase in price, that's because people are still paying for it and they're making more and more money. But at a point at which people are unwilling to pay the price, you will see the price start to come back down. Almost all pricing works like this, where companies will continue to charge the absolute most they possibly can without their revenue taking a hit. So if prices are too high and we as consumers collectively stop purchasing these overpriced things, then the prices will come back down, which is what we're seeing. Now, for cutting expenses, they're doing two things, AI and outsourcing. And the outsourcing thing is a little weird in some instances, specifically this one. This New York chicken joint employs cashiers zooming in from the Philippines, and they still want you to tip. Now, this picture specifically went absolutely viral. I believe it was on Twitter. It is not X, it is Twitter. And it's of someone from the Philippines zooming in as the host and also as the cashier, where you order like you normally do against against a screen, and they on their end will type it into whatever point of sale system that they have over there. And the idea is if it costs $12 or $15 an hour to pay a cashier in the United States, it probably costs like $2 to $5 an hour to hire someone in the Philippines. Now, obviously this got a lot of backlash, but you have to think of it in terms of how much backlash they got to how much money that they are saving off of it. So if they got a little bit of backlash and their sales dropped by say 5%, but they're saving so much money by doing this, they might actually still come out on top and continue to do this because their revenue, their bottom line, continues to go up. Now, the second big way that fast food companies and also most food-based companies are trying to get around having to pay people higher and higher wages is by employing AI. And this is probably something that you've seen in like McDonald's at the drive-thrus where you just ask an AI and it'll ring up your order for you. Or if you've gone into a place, again, it's usually McDonald's where you just order your food at a kiosk. You now have to hire fewer people to do the same amount of work because we've built machines that are able to replace these kind of simple jobs. Now, in the long run, machines will be cheaper than people, and so it makes sense from a purely revenue perspective to invest in these machines to try and save money in 10 or 20 years. But just remember, your dollars are power, and companies will respond to you choosing not to spend your money and use your power, and they will lower prices. We just have to do it collectively so they feel the pressure. Thanks for watching.